everyone's doing well, and welcome back to another lesson. So, this lesson has been, sort of long awaited. I've been talking about it for a little bit now, and it's a very big one. All right, so if you're on this lesson, you've most likely finished the whole YouTube mentorship. Now, at your disposal, you have a lot of different tools. You've learned a lot of different things. You've learned, all the technicals, the macroeconomics, the psychology, and so forth. You know how to trade, but how do we condense that into actually trading, right? How do we turn that into a profitable strategy? But that's what we all want. After the education, that's what comes next, right? So that is what this lesson is for. Now, we're going to be talking about creating a strategy. We're going to be working with an example that I've created, sort of very basic one. Potentially you guys might be able to use it. You might be able to tweak it, adjust it to your own plan. But by the end of this video, ideally, you guys should have a sort of layout to create your own strategy, your own profitable strategy, and you also learn how to check if that strategy is profitable and the requirements you need to make that strategy profitable, right? So cool, let's get into it. Now, any strategy, right? So what is a strategy, first of all? It's like a set of instructions, right? It's a set of rules that you follow to sort of yield a result. Now, any strategy that you have needs to have parameters. It needs to have those rules, right? And with these rules, we can't be too specific, but we also can't be too, loose with them. See, it's sort of like a recipe, right? I'm sure some of you guys have cooked before. When we're cooking, right, sometimes there's certain things you can play around with to change the outcome of, whatever you're cooking. But there's also some non-negotiables that you just have to have in that recipe to create whatever you're trying to create. Sort of similar with a strategy, right, to an extent. We can't be too specific, right, all the time, because then it might become very hard to sort of perfect what we're trying to do. We might be chasing perfection too much, but we also can't be too loose, because then you might end up with very bad results. We have to sort of find a balance with everything, right? But to be able to set rules, the first step is to realize what are we setting rules in. Now, some of these may be subjective, but I'll give you all my angle on them. So the first thing is a pair. Now, when we trade, from my experience, right, from seeing other experienced traders, I believe it's better to stick to less pairs. Stick to one or two pairs. Now, throughout the mentorship you guys have seen, I always touch on Euro USD and GBP USD. They're traded in conjunction with the DXY, right? It all makes sense. It's very logical. I think it's a very nice trio to sort of have in your asset class, right? Just have there to trade. Now, some of you may trade stocks. Some of you may trade crypto. You might trade other forex pairs. That's fine. Figure out what you're going to trade, right? And that ties into time. Now, when we trade assets, there's logical and, high probability times to trade those assets. Now, for those of you who follow ICT, right, for the stock market, for example, there's 2 sessions in the day, right? Those sessions are placed, let's say the AM session in the UK is about 1:30 p.m. to 4 o'clock, I believe it is, right? So in New York time, that translates to 8:30 a.m. to 11. That's the AM session. Now, you guys watching and listening, you probably all live in different countries. For a fact, I know you do, right? So you have to find out when these high probability times line up with your trading times. Now, for example, if you're from New York and you want to trade Euro USD, does it make a lot of sense to trade the London session? Probably not. Why? It starts at 2 a.m., right? When we trade, you guys know this from the psychology episodes. When we trade, we want a routine. That routine needs to be sustainable. Trading itself is already hard enough without you making it harder for yourself. So when it comes to these sort of things, it's good to make the easier choices where you can, right? Where it makes sense to make them. Now, let's assume you've decided a pair. We're going to go with Euro USD, GBP USD. We're going to consider both of them. And we're going to be trading the London session, right? I'm from the UK. London session makes sense. It's 7 to 10 a.m. for me, right? Pretty perfect. Now, market conditions. Does your strategy need a trending market for you to trade it? can this strategy be applied to a consolidating market, right? Is your strategy sort of swinging? Is it scalping? It's very important you understand that, because then you'll know if the current market conditions are sort of valid for you to execute your strategy. That needs to be a part of it now. What is scalping, what is swinging? I'm sure most of you know, right? Swinging is sort of holding bigger trades on a higher time frame, sort of trading the 4 hour, maybe even the 1 hour, the daily. Whereas scalping is very intraday based, much smaller movements that we're trying to catch and profit take on. So cool. Now rules, right? Of course, all of these things are sort of rules as well, but very specific rules for your strategy, right? Outlining if X happens, and then this happens, then I will look to engage. I need this to happen before I can execute. Now, a very, very simple example of a rule, I've touched on numerous times. We are trading in a kill zone. The trade has to be in a kill zone. That's rule number 1. Now, rule number 2, right? So very if something, then that's the sort of process we're following. If there is a sweep in the kill zone, right? A sweep on liquidity, then we can look to execute, right? That sort of validates the trades that we're looking for. If I'm looking for longs, I want to run on sell side so that we can look for longs, right? Every strategy needs a sense of risk management and profit taking, and also trade management, right? They're all tying together. Now, risk management, how much are you going to risk on your strategy? Right, I think this is very dependent on the R of your strategy, the risk to reward, right, generally. Now, if it's a strategy where you're aiming for 10R, you're very, very likely not going to have a high win rate, right? So in a scenario like that, it doesn't make sense to risk 1%, right? You're better off probably risking 0.5%, maybe even a little less, right? That'll be dependent on the testing you do, and we'll get to that in a second. But it's vital, right? To stay in the game for a long time as a trader, you need to make your trading sustainable, right? So it's very important you understand how much you're willing to risk, right, in your strategy, on your entries, and even in a day, how much you're willing to risk. Now, the way I've always said it, the maximum loss I can take in a day is 1.5%. My initial setup is a 1%, and my second setup will be 1. So these are the rules I've set for myself. Will be in a different kill zone, right? Typically London close kill zone because I'm a New York trader. I'll patiently wait for a good setup. If the setup appears, I'm willing to execute using 0.5% risk, aiming for a 2R to recoup my initial loss. Now, if that second trade also goes bad, the maximum I can lose in a day is 1.5%. Part of my strategy is also, if I'm in drawdown from my initial balance, I'm risking 0.5% as a default. Why? But do you know how many trades you have to lose in a row to blow an account risking 0.5%? Just building a sense of safety for yourself. Now, same with the profit taken. I've sort of, touched on it. It's dependent on your R of your trade. Now, sometimes when people take profit as part of their strategy, they set logical targets. For example, their target might be, when price runs one side of Asia range, I will take profit on the other side. Right? That's up to you. I think with profit taking, this is one of those rules that doesn't have to be super specific, right? It can be a bit, flexy. Because you might want to aim for 2R, but there's no logical R target at 2R. So you reduce your TP to 1.7R, where there's a sell side liquidity pool. You want to take profit at the other side of Asia, but it's only 0.3R because you're entering quite close to it. So of course you may extend your TP to the next target, right? It's about using a lot of logic. Now, your strategy, what people will probably think is very important, is the entry model, right? I think it is important, but it's not the end all be all of your strategy, right? It's the last step. Once you've got this framework, you're considering what you want to trade, your direction, your bias, whatever, the narrative, the important stuff, we're looking to enter. I don't think entering it as hard, right? Because if you're aligned with price will offer you those entries. Of course, not every day, but in a high probability trading environment, you will receive those, right? And your entry model, you want to have it noted down. What are you using to enter? My strategy involves a market structure shift. What does every market structure shift have? A breaker block, right? So your strategy could simply be, oh, I'm going to enter on the breaker block every time. My strategy involves displacement, the creation of a fair value gap. So if your strategy involves that, for you to even take a trade, what needs to happen? A fair value gap needs to appear, displacement in your direction. So each time, what can you do? Enter on that displacement of fair value gap. See how you can make it all just link in, just make sense, right? And the last step here, the repeatability and the conservativity of your strategy is very important, right? When we're in the market, we are not trying to milk the market, guys. There's a very big misconception most starting traders have. If you try and make 10%, 11% on a consistent basis in the market, trust me, you're in for a shocker, right? You are going to get blown out of the waters very, very quick. Now, I like to stick to the lower strategies. I think they're very repeatable. They're fairly conservative, but guess what? When you aim for less, you're much more likely to have a high win rate, right? So what does that come with? What does a high win rate come with? Just think about it logically, guys. Psychologically, what is that doing for you if you're winning all the time? You're in a better headspace, right? I'm not, of course, I know there's always a debate on lower versus higher. I don't want to knock higher traders. If it works for you, it works. That's fine. But for the majority of beginner traders, I think focusing on a lower strategy makes a lot more sense. And trust me, 2R can pay. When you build it up, when you build your capital over time, it will definitely pay. And the last step, like I said, it works for some people. It's based on your personality, right? So you have to decide what's best for you. All of these things that I've listed here today so far, they're for you to evaluate. I'm just giving you the sort of blueprint for it. So cool. Let's get a little bit deeper into the entry model. Now, I already mentioned some things, right? I gave you guys two examples, the displacement example, the market structure shift example, right? I think it's very important to have a checklist. Now, in the mentorship, I teach this, right? In the execution entries, you need to have an idea of what price needs to do to sort of validate you entering a trade here. It's very important. Is your strategy based on continuation, breaker structure, right? Is it based on reversals only, market structure shift? Which array are you looking to enter on? Do you need to see displacement? Do you need to see a fair value gap created? And so forth. Does your entry need to be in premium or discount? Right? Does it need to come to the OTE? You have to consider all of these things. But therefore you to decide how many factors you sort of want to add to it or you don't. You have to pick, and you'll be testing those, right? Again, we'll get to that in a second. Now, time and price, very important. Guys, so simple. Just, if you're an intraday trader, please just keep inside the kill zones or your sessions if you trade the stocks. Just make your life easier. That is when the high probability setups appear, right? And it's very important that you stick to the rules you set. Because when you tell yourself, I'm only going to sort of trade in these kill zones, and you create a strategy based on that, you're going to have certain results. So if you ever deviate from that strategy and start taking trades outside, you're going to interfere with those results, right? And if it doesn't go in a good manner, if you start taking losses, then it's like, oh, why did I do that? I knew I shouldn't have. I didn't follow my rules. So it's always so important that you're disciplined and you stick to the rules you've set out. Now, it's also very important to consider news events. Not all of you will be confident enough to trade them, right? They're very contextual. News events can have, of course, they can have a big impact on the markets. You have to understand which news events you just avoid and which ones you can sort of let pass and get yourself involved in after. And some of them, depending on what price action is doing, you can even, be in a position before and be happy to hold through. But always, of course, manage your risk. Move your stops to break even or potentially into profit and so forth. That management will depend on, again, always it's very subjective on the context. Now, of course, I've spoken about some of this today, but this is a very solid example of strategy and some of the things we can consider. So cool. The pair we're using is Euro USD or GBP USD, right? We're going to pick one of them. We're going to pick one of them based on Euro GBP. That's part of the strategy. We're going to see which one lines up using DXY. The time, we avoid Monday to start seeing the weekly range form, and then we trade Tuesday to Friday on the days that we're confident we have a good direction. We trade London open session. We mark out New York midnight price, the Asia range. We're looking for price to tap a high time frame array during London open kill zone, and we wait for displacement away, causing a market structure shift. We take entry off the OTE and we hold to 2R. I risk 1% each time and always close the whole trade at 2R. You see how this plan is very concise, but still specific. That is what you want from your strategies, guys. You just need to know what you're doing, essentially, right? No, that probably sounds a little bit silly, but a lot of people, if you ask them, what sort of validates your entries, they might have different answers on different days. That is not what you want. You're looking for the same thing consistently. Now, when we have a model like this, will this happen every day? No, but you don't need it to happen every day. You just want to be active. You want to be on the ball. Even if this happens once in a week, 2R in a week is very good. Trust me, it's a very big misconception that it's not. It's definitely good, even if you catch this once in a week, right? That is what you're looking for. Now, you might want to write your plan out like how, I have here, in a sort of paragraph, a couple sentences, make it very easy for yourself to follow the thought process. You can just bullet point it. But whichever way you do it, I always say to people, have it written in front of you. If your plan is, if you have a whiteboard and it's near your setup, just keep it written on there. Right, that is what I say to people. Another thing I always say to people is write your lot sizes on there. When you're trading an account, you don't want to be fumbling around with calculators. When you backtest your strategy, you'll see most of your stop losses are usually between 5 to 20 pips if you're an intraday trader. So just write down all your lot sizes for those pips, those stop loss sizes, right? That's just a bit of an extra tip for you guys. But yeah, same with this. Always have it on a whiteboard or, pinned to your laptop screen, something like that. You just want it visible to you. If it is in front of you, you are so much less likely to deviate away from it and break your rules. But sometimes it can be very tempting. And I understand. When I talk about these things, I talk from experience, right? I've been there, trying to break my own rules, trading things I shouldn't have traded. And I'm telling you, sometimes they go well, but when they go well, it's not a good thing in the long run. It just enforces something that's not good for you. It's always better to follow your rules. Even if sometimes you're going to take a loss, but that loss is accounted for in your system. So now let's assume you've sort of got a strategy written out. You've got a good idea of what you want to do, similar to what I've written here. You can sort of answer all the questions that we went over today. What's the next step? The next step is backtesting, right? When we backtest, it's for pattern recognition. That is one part of it. Pattern recognition, what is it? Just seeing it, right? Just seeing your strategy play out on the charts over and over and over again. Seeing it form. You want your eyes to get used to it. But you're going to be trading that. Trust me, trading is boring. You just want to see the same thing again and again. Now, how can we do that backtesting? You can use replay mode on TradingView. Or you can use something called FX Replay. It's a software for Forex backtesting. You can use any charts on there. I actually have a little discount code for these guys. They offer a monthly subscription, so I'm going to drop that discount code in the description for any of you that are interested. They also do a 5-day free trial, so you can sort of try it out before you have to commit to paying for it. Now, what else do we get from backtesting, right? We get a calculation for your win rate. Now, if you go back to this, I risk 1% each time, and I always close the whole trade at 2. For a strategy that's sort of strict in that sense, it's very important we have a win rate, right? Now, the reason for that is sometimes you may get trades that go to like 1.5R then reverse on you. And, you just let it run to 2R. or you wanted it to run too hard, but it actually reversed on you. So it's very important you have an understanding of your win rate in the long run, but you don't want to end up taking losses. Otherwise, do you know what you need to do? Refinement. Backtesting is essentially practicing your strategy in a way, because when you're backtesting, when you're seeing it play out, you might start seeing a recurring pattern. Oh, you know what, this 2R thing isn't really working. Let me move my take profit to 1.7R. Backtest it both ways. 1.7R, my win rate is 78%. 2R, my win rate is 54%. Does it not make sense to trade the 1.7R strategy? In the long run, you can simply do the maths on that, and it will make a lot more sense to trade the 1.7R. So once you've done that backtesting, right, and you've made those refinements, you sort of tweaked the strategy, you've seen any, problems you've seen with it, sort of fixed them. What's the next step? The next step is forward testing. That is the logical next step to your strategy. So what is forward testing? You're essentially looking to trade, actually execute now on a demo account, right, before we go live. First line, practice makes perfect. When you start trading these strategies, you may mess up a few things. You may put in the wrong lot size. You may not execute in time. You might not set the right limit. Practicing will get rid of these things. It will get these things out the way, so then you're actually ready to trade your strategy as it's meant to be traded. And secondly, adjusting to lifetime. Seeing your strategy play out in hindsight is not the same as seeing it appear in lifetime and being able to trade it. So it's very important you gain experience doing that before you sort of take it live. Seeing your strategy appear in front of you, slowly form, and then being able to execute on it is very important. Not just seeing it in the past, seeing examples like, oh, this works. Seeing your strategy have played out, right, sort of already on the chart, is very different to seeing it appear and form in front of your eyes very slowly, right? From there, we can move on to the final step. So by now, what you should have is a strategy, a model, right, for your entry, and rules that go with the strategy that you're going to follow. You've backtested these rules, or rather the whole strategy. You've tweaked it, you've got rid of problems, you've made it to your liking. So you've tested it in lifetime, and you've got rid of any problems that you were potentially having, right? You found success doing that. What's the next step? Take it live, right? Now, the step from going from forward testing to live, what I like to say to people, the majority of you guys are probably going for funded accounts. What better way to prepare for a funded account than emulating the environment of a funded account, right? So what that means is, right, what I tell my own private mentorship students to do, let's build this model. Usually I go on a Zoom with them one-to-one, work through a strategy, make sure they're ready, make sure their strategy makes sense, they've taken the right things into consideration, all of that stuff. Then I told them, in your forward testing, go and test this strategy. I want you to make 8%, right? I want you to make 8%. Don't lose more than 5% in a day. Don't lose more than 8% overall. Now, that is just following the rules of the prop firms. I told them do that 3 times in a row, because 8% is phase 1, right? We can ignore phase 2. If you can pass phase 1, you can pass phase 2. Trust me, it's purely a psychological barrier if you can't. So I told them, if you do that 3 times in a row, the first time could be what? It could be luck. The second time you might have had a good run. Do it 3 times in a row, it's you, right? It's calculated. You're performing well as a trader. That validates you trading. That's the jump from forward testing to going live. Because now what? You've done it 3 times in a row, what are you doing now? The exact same thing. All you want to do is just carry on what you were doing. Do not change anything. You want to follow your plan. Guys, you've got a plan now. You've worked out your win rate. Do not deviate from this plan. If you start deviating from the plan, you're going to cause issues in your system. You might have losses that you're not able to account for. They don't come under your win rate percentage because, of course, you don't follow your rules. So, follow your plan. Now, one of the things I want to talk about is loss streaks and win streaks in your system. They occur, right? They occur both ways. You get loss streaks, you also get win streaks. They always balance out. When you're in a losing streak, always remember that. When you're in a winning streak, always remember that. It's the same both ways, right? But in the long run, let's say you test your strategy over the space of, let's say, a year, and you see you have a 70% win rate. You might go on a losing streak for like a month, right? It might be bad, but the next month you have an amazing month. But by the end of the year, what you see is, my win rate was still 70%. Maybe slightly less, slightly higher, but roughly 70%. So it's very important you sort of understand that. Now, one more thing that I talk about is averaging out, right? When we're trading these phases, when we're trading these accounts, when we're doing the demos, it's sort of not real money, right? But when you're funded live, it is real money. And you might, opt to take profits a little faster. You might opt to essentially average out quicker. That's fine. I don't think there's anything wrong with that. But if you have a tried and tested system, what I recommend to people is stick to it. It will still make you money. It will yield your results. As long as you have rules in place for, if you're going to draw down, take a big loss, etc., you'll be fine. But again, those are all things you need to account for beforehand. Before, being put in that position. You don't want to get into a bad position, then have to make up rules. You want to be prepared for those things before they happen, right? That is it for today's lesson. I know, not a lot of charts today, a lot of talking, but I hope that helped all of you guys, right? There was a lot in there, so, some of you may need to rewatch this to help write your own strategies up, but, hopefully I covered everything that you need for a strategy, or if not everything, most of it. As usual, all my socials are there. If you guys have any questions at all, just drop me a message.